All right, good afternoon, everyone. We are live. Let's see here. Can everyone hear me? First off, make sure we're okay so I don't talk to myself. There's Giandrea.
Andre, hi.
Message out. Andre, good. Good to see everyone. Wait a little bit and get a few more people on board.
Well, of course, we don't mind, Zach. Welcome.
All right.
Okay.
Jeff says can definitely hear me.
Yes, you're glad enough to wake the deaf.
Okay. All right. So we're getting geared up here. This is going to be interesting because this has been a couple interesting weeks. I mean, last week we had a bit of action. And that carried on as we got into the weekend. Things really went a little bit ballistic, as everyone probably knows. So we're going to have a lot of fun talking about that. Got lots of juicy stuff from the charts. Some good trading action. Challenging, depending on how you're positioned. And, you might have had to mitigate some risk. You might have had to adjust trades. That's life. It happens on big moves, but I can't remember. I think Bitcoin moved to 12% or something, Richard? On
a huge move. So I've got a graph here. Let me see if I can share the screen.
Yeah, go ahead.
I'm going slightly off script, but hey, we are the rogue traders. How do I do share screen? That one. Share screen. That one. Bang. Bam. This is the immersive market data dashboard, and they're soon adding the risk dashboard. And actually, we'll be doing a promotion in Rogue Traders fairly soon, offering our silver or better members a free beta test of this package. So anyway, this is me looking at the last 1 month of Bitcoin, and as we can see, pretty boring start to the month. Vols were super suppressed. And then we had that 7% wick, which I'm sure scared everyone because that caused vols to go up. Have a look at put the 1 month vol on here. So you can see that if you just see there that there we are. The wick happened and the 1 month vols just followed it as the market reacted. And that was enough to shake the confidence of everyone who'd been selling vol at low vols during the doldrums here. And then we went into a higher vol regime. And actually, I must admit, I thought, okay, we were in a higher vol regime. Let's sell some vol. And then presto. Yeah. So we went into major delta hedging mode. Yeah.
It's going to say it happens a couple times a year, doesn't it?
Yeah, actually, that wick, we have never seen a wick like that in the data on the call side. We've seen them on the put side, but never on the call side. So that was interesting, and that was around the fake ETF announcement. It was directly because of that. And then I think the next push up on the 20th was because of the
ETF.
DTCC website had published details of the Bitcoin ETF, and so of course everyone had sold vol, thinking, hey, we've finally got some vol to sell, and then of course everyone started having to delta hedge like crazy, and so the market pushed up, and as a consequence, what you can see is that the 1 month implied vol almost tracks the value of Bitcoin. 1-to-1 correlation, which is quite fascinating. It pretty much means that everyone was selling calls, right, and had to delta hedge, or everyone was short futures, trying to pick up yield, and then had to go and buy calls or somehow get out of their short positions. Massive liquidations all round, really tough. We've had a really solidly busy 4 days managing the book, fighting hard to keep the intrinsic value, to make sure that all the mark-to-market losses fade away. And actually, a lot of the mark-to-market drawdowns people will see will actually be due to vapor, which is the effect of the pink line going up. Of course, so we're now at sort of, for the year, fairly historical highs in volatility. for the life of Bitcoin, not necessarily that high, but certainly elevated vols where there's good value, in my view, because it was what at the moment 56 vol. Market has to move pretty much 3% a day to if you're delta hedging properly to hurt you if you're short vol here.
Yeah, cool. So what we'll do is let's go through some charts. We'll talk about what we're seeing on Bitcoin and Ethereum, and then maybe we'll talk about those moves and some of the things and how people can either guard against them, profit from them, or hey, you're on the wrong side. Okay, fine, it happens. Maybe how to mitigate it. So let me see here. Do I have this? Oh, the slide's up. This is it here. Big moves and fake news. Well, that's the last 2 weeks. Big moves, fake news. That's and fake news is the theme of the last 3 years, really. So, I think we're pretty trendy. Oh, and as always, before I forget, everyone, if you want to check out, we want to hang out with us on the Telegram channel during the days we trade. Post our trades there. We chat with our people. We have a call every Monday with our silver and above members. Jump on over to Rogue Traders. Join us if you want for a week for free, and we can hang out. And as always, if you check out on the chat too, hey, if you haven't joined Deribit yet, if you're new to Deribit and you want to save 10% on fees, just use that little link up there and do us a solid. Okay, so let me just shut this off for a second here, and I'm going to share my screen. All right. First of all, Bitcoin. This is the big one. We have we have the big spike. We can see the vol spike. We can see the move up, straight down. Beautiful. If you're watching, if you're sitting in front of your screen, you see something that big, it's always worth it to take the other side to see if it pans out, because it's a limited risk trade. And what I mean by that is we're up here somewhere and nobody knows what's going on. Well, if it's moved up 7, 8, 9, 10%, buy some puts. Buy some puts because they might be worth 1,000% in 2 minutes. Those trades always don't work out, but that one did. I didn't take it. We on the call last week, we talked about this, and I didn't get that trade because we were busy managing things. But whatever.
I had that on my systematic book. Actually, I was working with my partner, and we were discussing this tail risk idea, and we put on this. I think it was 3% up stop limit or stop market buy with a corresponding bid on the puts, low delta puts, and we were woken up by the machine getting filled.
Well, during that spike up, we were on our Monday members call, aren't we?
Yeah, that's right. Yeah, and so and in fact, on my home in quotes, my home playbook. That's right. I was actually on the book at the time, wasn't I, on the call? And I remember saying, "Look at that wick. I don't believe it. It's fake." And then said, "Actually, I better hedge it because you never know."
Too bad you did. Yeah. And the reason why you called it fake was because you saw one big buy order, one big sell order, which is usually a fat finger. Usually someone's making a mistake. It
was literally one order had moved the entire wick in that 1 second, and that's a guarantee somebody's fat fingered that or.
Yeah. So we could see here, and actually this little thing here I drew this morning, maybe 4 or 5 hours ago when we came into the office. Richard was saying, well, what do we think the market's going to do? I said, well, look, we've got a classic ascending wedge pattern here. Again, I don't rely heavily on technical analysis. I use it to kind of supplement and enhance and give us ideas of where we should be or shouldn't be selling or buying options. And an ascending wedge is typically a reversal pattern. So we started to see it come off. Whether it will come to fruition, it'll come down. I don't expect Bitcoin to reverse this entire move. I mean, it could do anything. But I would expect, some weakness and maybe to come down to its trend line here. Again, we don't lean on technical analysis. We just kind of give it a nod of consideration for this style of trading. Now, Ethereum is a little different picture. And we can see this morning it did a little poke above the high, right back down. That's usually a good indication that's probably done. But, or at least for now, that doesn't mean it's not part of a larger, broader uptrend, and it might keep going up for the next 6 months. Who knows? However, here's our trade that we had on. We put collectively on last week, and my apologies to everyone because I didn't put the trade on right after the call or the next day. I did it on Saturday, and a little bit of the move started already, and I was like, oh, why didn't I do it yesterday? But the agreed upon trade was we're going to do an Ethereum 1x4 spread. So we're going to buy the 1,700 calls close to the money, near the money, somewhere around there. And we're going to pay for it by selling 2,000 calls, 4 of them. And that completely paid for it. So this is basically, we've got free long calls at 1,700, essentially. And that trade worked out really well. Obviously, we're in the money. So you can see So far. Well, it didn't cost us anything.
Yeah, it's a zero cost trade with a break even all the way up to 2,100.
Mm-hmm. This bottom line here is 1,700. This top line here is 2,000 where we sold the calls. And this line on the right-hand side is when it expires on November 24th. Our break even, I probably should have put our break even in. It's up here. And we'll just call that the break even.
Yeah.
So far, it's looking pretty good. I mean, we still got a full month left, or maybe just less than a month. And we could have asked for much more. As long as it expires, kind of up close to 2,000, that would be perfect for this trade. That would be maximum value because the calls expire worthless, and the 1,700 long call would have the maximum value in it.
It was we bought that spread at a slightly lower vol, didn't we? Well, actually a much lower vol. So the long leg has a massive price increase because of vol at the moment, and the short legs also have a big price increase because of vol. So actually the trade is currently slightly underwater, but most of that is actually Vega. So I think as soon as the vols die down, that will just be in profit, probably until the end of its life.
Mm-hmm. And that. Then, let me turn my screen share off. That brings me to the poll of the day regarding this position. Do you think we should manage this trade we've just put on, or we put it on last week, or let it cook? Do you think we should just let it be, see what happens, or take it off right now? And if we take it off right now, we'd actually be a little bit of a loss because Richard mentioned the Vega. That's hurting us a little bit right now, but we still got a month. All right. I'll let those numbers come in, and then I'll publish the poll at the end of the call. Okay, Richard, is there anything we want to talk about in particular here with these? The fake news, we talked about that. Hey, you get this one-off move every now and then. If you're sitting around watching it, I like to take the other side of those trades, whether it's buying options or buying futures or selling futures. You see that big spike, you think it could be a reversal. If you do it with options, sometimes the options market can get a little thin and it's tough to get in. Okay, fair enough. You can do it with futures. The nice thing with doing it with futures, so for example, I'll just share my screen again. Let's just say we were, Johnny on the spot on this move up here, we happen to be watching. Well, if we sell futures thinking, this thing's going to, maybe it won't collapse all the way back down, but it'll retrace 50% or whatever, retrace a big portion of it. Well, if you're wrong, I mean, just put a stop loss order up above, a stop market order. So if you're wrong, you give yourself a bit of wiggle room, and boom, you're out. So it's limited risk. With options, of course, it's limited risk if you're buying options, because you're not going to lose more than what you paid. Now, I have kind of a little bit of a rule I like to do when I'm buying options in that case. If I'm wrong, and wrong means I'm wrong in the moment, I might be right over time. But if I'm buying an option that expires tomorrow and 2-3 hours go by and that move still hasn't retraced, I'll probably just get out. But if the option goes about 50% against me, I'll usually try and just get out and recover half that money and just say, my timing is off or whatever. So that's kind of a bit of a rule I like to have there. So on those wicks, if you're around, great. If you have an auto hedger, for example, like Richard, you might be hedging all the way up through this, and then come all the way back down. So it's going to cost you a bit, right?
Actually, I've got some stuff to say about that, because actually what happens in a wick like that is that there's all the liquidity in the market vanishes. So auto hedger or not, you end up buying at the top and selling at the bottom. So actually, it's hugely damaging. And actually, it's I think it's better to, well, if you are going to hedge at the top, you should immediately buy puts, buy some 2 or 3 day low delta puts to the same notional value as or maybe double the notional value of the futures you bought. Just in case there's another wick down. Now, it happens once every 3 years, but when it does happen, it's pretty damaging. And in the scheme of things, the cost of those futures is going to be, you might overpay a little bit for them. And also what we found was that even the market was empty, both because of course everyone pulls their futures orders and everyone pulls all their options orders at the same time. So you take what's there, and then there's nothing left, and suddenly you're the market maker along those puts, and then you're just waiting for the people to come back in and sell them to you. So you need to bid a bit more. I like to bid like 1.5 times the true value. But you don't get much time, so it's probably worth setting those things up early. And so what I was going to say is, if you something like take a 1 standard deviation move and put your stock market orders there, and then compute what the puts are going to cost once they get there, and then offer that plus 20% or that plus 50% for those puts. And so if you do get the wick, then you're protected. You don't lose anything. And if you don't get the wick, it stays up. Well, you've bought some puts. You can always, you slightly overpaid for them, but but vols are going to go up anyway, so they're probably going to not lose any money, and you can always roll them off to something more useful. So probably an overall a good trade. That's part of the whole tail risk strategy. Another one is if you're selling vol, particularly in low vol markets, then you might want to take, I don't know, 10, 20, 30% of your profits, your theta decay every day, and spend that on very low delta, close to the money, near dated calls and puts. It reduces your income for sure, but the payoff is that every 100 days you don't get wiped out.
Yeah, good advice for sure. Well, and in terms of, okay, let's talk about the big run-up we had, the 12% move, which has held so far. You might get caught on the wrong side of that. Maybe you sold some calls and now they're in the money. We had that happen. I mean, it happens all the time to us, and we managed it. But a lot of people get extremely stressed because they see their P&L go down. They see the theta income coming in, but they're not realizing it. Vols are elevated. They're not sure what to do. They roll up. Maybe they roll up to a safe out of the money strike. But the name of the game at that point, if you haven't hedged, is probably patience. It's going to roll back. If you're just doing one strategy at a time and you end up being right, so you kick the can down the road for a week or 2 or 30 days, whatever you rolled out to, as long as you are correct and those new calls that you rolled up and out or wherever you rolled them to expire to the money, you're getting that money back. So your equity will slowly rise as you get closer and closer to expiry, but it's a hard thing to do. It's a hard thing to sit there and see that P&L again to think, oh my gosh, what's happening? I did everything right. Why is my P&L down? Well, that's why. And that's also a reason why Richard hedges. So he's giving up something, but he doesn't have those big swings, those big drawdowns typically.
Yeah. If you're running a dynamic hedge, you can trade much bigger positions, which means you can take advantage of much more advantage of the high vols when they come in.
The other thing I'll mention too is that okay, you've had a position go against you, whatever that's left, that's trading, let's deal with it. Well, what if you're not doing anything and you think, well, maybe you knew the market was going to go, maybe you felt it was going to go, maybe you had no bloody idea. But do we want to have some long gamma all the time? As a positional retail trader, do you want to have that on all the time? It's expensive. You can burn through a lot of cash by just having long options and praying that it does something while you got them. That's not the smartest strategy because that's, again, you're just going to burn through cash. What if it doesn't move for 6 months enough for you to make that money back? It was a waste of your time. So it's a balance between selling options and earning some regular income, some theta decay, and being long. Maybe you're long on the wings. Maybe you've got some low delta calls and puts. You're not looking for a lottery ticket, but it will pay you, and it will offset the damage for when you are wrong, for when a move like this happens and you do get some move goes against you. Well, you are hedged. It's a distant hedge, but it's going to help.
Worth mentioning that I've just shared the chart again. So the pink line is the at the money 1 month, which is kind of the sort of standard sort of measure of vol, and the purple line is the 1 week, where people like to sell a lot of vol because it's quick money, and then the cyan line is the 3 month. And notice the 3 month tends to be higher than the other two most of the time, but actually in the current regime, not much higher. But the Vega, the change in vol is amplified by the fact that the position values are so much higher on the 3 month option. So and also notice the 1 month and the 1 week tend to track each other. There's a bit of differences, but they tend to. So actually, if you're selling, for example, 1 week, then buying some 1 month Vega and Gamma can be a reasonably good hedge for large moves. So that can hedge off the Vega. And it hedges off a little bit of the Delta too, but not much. And it doesn't cost you a lot in terms of the time decay on a 1 month versus a 1 week is tiny. And the time decay on 3 month versus 1 week is almost non-existent. So they provide a little bit of Vega hedge, which brings me to one of the questions that's been asked.
All right, why don't we jump into those now? So I'll just start at the bottom. I don't know if we'll have time to get to all of them, but Stanislav, that was the first question.
Some great questions this week.
Yeah, they are very detailed. So Stanislav says, in a previous topic, I heard that when selling vol with calls with DH, the ideal scenario is if the market makes a breakthrough and your calls become at the money to roll them out. Why? After all, there'll be a huge loss, even with hedging, even if you caught a good difference in volatility. Maybe I missed something. Can you explain how does it work and adjustment nuances?
We did a video on this. The first Arabic video we did actually was hugely long and detailed and way too much for this session, but it's on YouTube and you can find it. And it's because of the smile dynamics. You are selling vol at the wings, hopefully much more expensively than you would at the money. So the move won't damage. Well, the damage you take to the P&L on the short call is somewhat offset by the fact that the fallout of that position hasn't actually moved as much. And if you're hedging the smile, then you're actually essentially over hedging as you go up, which means that you've got a bit more firepower in the perpetuals or futures you bought on the way up, which means that you're slightly ahead of the game. You won't feel it because you'll still be underwater, but that roll will be a little bit cheaper than it should be. And again, you'll roll out to the wings, and of course the wings will have steepened, and you'll get even more value in the smile on the next roll, and the next roll, and the next roll. So you'll end up kind of beating the market, because in the end the prices of options are the at the monies are kind of modelled on the realised vol, which is always at the money, and the smile is always there to catch the edge cases. So,
all right. A great question here from, I'm not sure, is it Heli? I don't know how to pronounce the name, but anyways, a really good thing here. So listen, everyone. So she's saying, I was long the 32,000 calls, the November 24th, for a couple of weeks. I was selling 0 day to expiration and 1 day to expiration calls against them every day. 5 to 10 delta calls. It felt like easy money. Then a 5-minute candle price pumped from 32K to 35K. I was underwater on my short calls. I couldn't cover them immediately with the vol spike and the wide spreads. Okay. Waiting a day, I managed to roll them out to 40K calls, end of November and December. Now I'm afraid if Bitcoin goes to 40K, I'll have to roll them to March already. Is this part of the game, or did I make a mistake somewhere? I hold spot Bitcoin as well, so the December, March would still be covered when November expires.
Probably the first mistake was actually not buying cover for those short positions. Because if you buy cover, then at least you've got either you'll go blast through your cover, so your loss is limited, so you've got much less to hedge, much less to roll. Or if you don't quite reach your cover at least will have risen in value and vol. So you'll have some money towards the roll. But yeah, basically that's the game. If you're selling zero data expiry, you're always juggling hand grenades, right? That's just the way it is, particularly with Bitcoin. I mean,
yep.
doing it with a stable stock like Raython or something might be more advisable. But
and we don't sell 0 day to expiration, or very rarely 1 day to expiration in crypto for that reason. It's not as the deltas aren't as reliable as if we were on the S&P.
If there's no prevailing news, I'll do it. If I see a spike because of a vol spike because of FOMC meetings or something like that, because these are generally artificial vol spikes in my view. But if right now we're in a market where everyone's jittery, you've got all the Bitcoiner files are all frothing at the mouth saying this is it, we're going to $1 million, and too much going on to. I mean, having said that, there's a lot of vol there, but I wouldn't do it without a delta hedger and some tail risks hedging in place for sure.
Yeah, at least put the tail risk on. At least And sometimes when I look at those 0 or 1 day to expiration, I look at those 5 or 10 delta calls. Sometimes it doesn't seem the juice just isn't worth the squeeze. It seems sometimes because we know Bitcoin can be there in a heartbeat, and you got to have that protection. And no, there's nothing wrong with your strategy in general. I think we just need to maybe look at lengthening the length of those sold calls slightly, in my view. But at least hedge yourself off by buying protection. A question from Stan: what type of protection is more preferable for a sold naked call or put? Delta hedged via futures or just buying the next option? By buying the next option, you just mean buying protection, I guess, further out of the money. Stan, just let me know in the chat. I assume that's what you mean.
Futures, or just buying the next option. I would buy cover as well as delta hedging, just in case you don't have time to react with the delta hedging.
I think a lot of people are going to say, "Oh, well, that's too expensive. There goes all my profit."
So you can't have it all.
Question from Ruben. I've been interested in Richard's trading style. Why? So I started learning with a small amount of capital. Okay, I've been selling volatility around 40 to 50%. I created a bot that automatically deltas to 0 as a maker at a certain percentage price move that also buys back my options so the delta reaches 50. Okay. Now with the increased overall volatility, at the money options often reach a volatility over 50%. What is the best way to proceed? Buy back the option at a loss, or let the option go in the money and wait for the volatility to come down?
If you've sold the option for more vol than the realized vol in the markets, then the best thing to do is let it go in the money. Probably. And then wait for the vol to come down and then roll it into a strangle or another call or something like that, I would say. Because you don't really want to be paying 70 vol on something you've sold at 40. That's my short answer.
Okay. We got time for another question here. Dennis, Richard said that during the beginning that he managed to keep the intrinsic value of the book, and if vol starts to come down, it will come all back what was lost to vol prior. Yeah. Do you watch then only Vega as the important metric?
Vega is a very important metric, and it's very much underdone. But it's extremely important in crypto because there's big volatility of volatility. We call it Volga or Volgamma in options.
Not to be confused with the Russian River.
Yeah. So Vega is important, and so having those tail risk hedges as low delta near expiry strangles can help a lot with that when there's a big move, because you get the move plus you get the vol coming up, and it particularly happens in the first 3 days, the next in the front week. Yeah, so Vega is an important metric, and I also look at the ratio kind of between theta and Vega. So how much am I making per day in theta versus how much is a 1 vol move going to cost me, and like today, or like this week, how much is a 10 vol move going to cost me?
Mm-hmm. Fantastic. Hey, that's all the time we have for today, everyone. As always, hey, join us every Monday on our call. We can chat as long as you want. For anyone who has a silver level or higher, join for 7 days for free. What do you got to lose? That's it for this week. Happy trading. The poll. I will just end it. There was no point in even publishing it because almost everyone said, let that trade cook, which is what I wanted to hear from everyone. I think it's the right thing to do. So let's see what happens next week. If we still got it on, I suspect we will. Oh, and an update on that. We will try for next week to get a specific trading account just for Deribit Live so we can actually show our positions and do a little bit more with it. It'll be a lot of fun. Anyways, as always, great to have you here, everyone, and we'll see you next week.